Hey everybody, this is Alf speaking. Welcome back on the Blockworks Macro channel. And today, guys, we have a pretty special guest. It's my honor to welcome on the show my friend Hugh Hendry. And for people who don't know him, shame on you. Hugh, how are you doing?
I'm fine. I think I've just taken a line of cocaine because you told me this is the 30-minute show. And so I'm going to have to speak very rapid.
No, you can do it short. Don't worry. You can speak slow. We're going to take care of it. Hugh, thanks for being on the show. You run a pretty successful fund for quite some time. You have, I think, a unique way of looking at markets. So let's start with markets today. I mean, what is the best analogy looking at the past, if you can find one analogy?
Well, I mean, to understand the man, to understand the person with the microphone, the only unique aspect of my fund was that for 15 years, I was uncorrelated. I was the thing that every lover of Bitcoin desires. I was an uncorrelated asset. Now, of course, at any one moment in time, I'd be focusing on having a concentrated correlation to something, but then we would move on. And over the body of time, I was uncorrelated. My returns were nothing to herald. I made 8%. But I was producing a positive carry on a tail risk uncorrelated fund. So that's who I was. And I think maybe that might help explain how I look at today's environment. And today's environment, historical precedents, I'm kind of looking at kind of gnarly points from the past. I'm looking at maybe I'm looking at August, maybe it's September, maybe it's October. I'm not quite sure the proximity, but it would be certainly 1987.
Okay.
You'll get the grouping because the next one would be February 2000, and then lastly, kind of August to October 2007. So these are three periods which clearly. Where these are three periods where 10-year treasuries and their yields were rising and causing people to obviously pair off. Like treasuries are typically the stabilizer. They can be many things. We've had a 40-year, we've had the greatest bull market ever in financial markets because we've had it in the risk-free security and owing to going back somewhat, but going back to for 20, 30 years, you were dealing with a security that had a vol of 10. And so it opened itself up for leverage. So you had direction, you had low vol, and you could leverage it. And, the financial landscape today is we have giants who captured that trade. Okay, so that's where you're trying to achieve an alpha and just direct returns. But for the common body of investors in 60-40, it's a respite when equities, get it in the ass. The problem is that when you get periods where you're kind of being incentivized to ditch, the hedge in the portfolio, it then leaves you exposed to the pure risk of the equity class. And so that's why I go back to those periods. And the stabilization in our world only returned when there was actually a profound and shocking reversion in the price trend of the equity family. There was, we needed a really bad risk event to kind of counter what was happening in treasuries. And that's kind of where it feels like the last 18 months, the private sector has taken it upon its own to tighten credit. We've raised 10-year treasuries from 47 basis points. We went over 300 basis points, and we're still, give or take, we're chasing the shadows of 3%. Of course, at the end of that process, the Feds walked in and said, "Hey, we're going to tighten." And we're like, "Oh God, no!" It's like your uncle dancing at a wedding. Like, please, we've done it, and anything you do now will just be. You make it like, just get out of the way. So that's creating this, in my mind, is creating a very fragile equilibrium, which makes it really hard to support having a large quantum of risk on the table.
Yeah. So basically you're looking at a market that is protesting against the increase in credit spreads and risk-free interest rates, which make the private sector have a hard time levering up further because it's becoming prohibitively expensive, right, to lever up. It's just, the whole borrowing rates are going through the roof. And equities have actually repriced. I think I calculated last time we wiped about $25 trillion of wealth from bonds, equities, credits, gold, and crypto over the last few months. So my question is, are we done yet there, or there is more to go?
Well, to put that in modern parlance, we've wiped out about 8 apples. Yeah, so Apple was the first stock to gain a capitalization of $3 trillion, right? So we've wiped out 3 apples. I think to answer your question, I think there's more. So let me put some meat on that statement. I believe that a very high percentage of the equity decline year to date is attributable to what I would call an elite grouping of riskless, or what were deemed to be commercially riskless equities. And again, Apple would be very prominent in that. And the desire to hold riskless equities was very much amplified when 10-year treasuries were yielding 50 basis points. That appetite to have an apple a day, the appetite for an apple a day is less when treasuries are yielding 3. And one becomes more curious about commercially risky equities, or again, to use old parlance, value equities. And so I want to say, by and large, a portfolio of value equities has been pretty robust and would have outperformed year to date. And then adding to the tension and the drama, what we've seen has been this reversion in desire for risk less. Mm-hmm. And of course, woe betide you, Mr. Corporation, if it's revealed that you are not commercially riskless. So, someone like Netflix or even Facebook, where they've had disappointing earnings, and the response is accentuated. You're talking about severe haircuts of like 70, 75%.
I'm looking at these periods you mentioned, 87, 2000, 2007, 2008. All of these preceded large deleveraging episodes, like pretty big stuff. So would you expect that we are looking into something like that? And why is that the case? Can you explain it to the Blockworks macro audience?
Heavens, I don't know if I can explain it to myself. So who knows what happens next? I'm sitting in Saint Barth's, building luxury houses and talking on social media. But I've got a kind of network of kind of cool, groovy, funky people, great thinkers who've monetized, who are like, stinking rich because they just tune into the matrix. I would imagine the next step is really, really smart people start pricing in the mother of all economic recessions. Really, really severe. I mean, I love I do not, I promise you, I have other weaknesses and foibles, particularly tequila, but watching Bloomberg or CNBC is not one of my weaknesses. But I see on Twitter, one of the hosts, John Toretto or something, whatever, he's a good guy. And it's a feat of insanity, because every day he's like, hey, well, Goldman Sachs, whatever leading investment bank, they're like, people are overstaying this, the economy is hot, we're just not going to get a recession, corporate profits are nonsense, right? The smart people are not tuned into Bloomberg and CNBC. And what we are seeing is that we had COVID. And at the point of COVID, of course, US credit cards balances were maxed out. And then there was the relief that came with these checks in the post. And there was an initial surprise because the money wasn't spent, that people actually brought down the balances. But then we hit about March 21. And this is where this is where the immortal stain on the Fed's behavior emerges. Because in March 21, it became apparent to everyone that we were going to experience a V-shaped recovery, that we were going to endure, we were going to survive, and we were going to re-emerge kind of around about the same levels as where we'd gone into this thing. Okay, and people across the world partied. And they kind of, well done them. You know, it was Prince. It wasn't 1999. It was 2021. But so I live in a party island. It's bloody expensive, but you come down and you lay some serious money and you have some serious fun. And fun has been off the charts, right? For the last year. Like the houses I rent, fully booked, prices up, everything. People want everything. And you go back looking at consumer credit card balances. They're like, again, like, woo, they're vulnerable. And so what are they vulnerable to? Look at Walmart's results last night. Walmart, what did they say? They said we got caught out because there's two forms of consumption. There's a liberty consumption, which is, hey, let's get more Netflix subscriptions. Let's buy Peloton bikes. Let's go to the restaurant. Let's go to the movies, whatever, discretionary spending. Let's buy a bicycle from Walmart. And then there's, hey, let's feed the kids. Let's put gas in the tank. Let's go to work. Let's heat the house in the winter. Let's have the AC on in the summer. And suddenly, that's taking a big drag on your disposable. And it makes those credit card balances and that natural assumption of perpetual spending, it makes it vulnerable. So that and my zodiac star sign warnings about the Chinese economy lead me to suspect that serious investors really will have to kind of dial in really not possibly prolonged, but really profoundly nasty recession. And so if that happens, then paradoxically, you will get a big bounce in the equity market because the swingometer for risk will say, hey, if I'm in equity, I'm trapped. Like lots of people are trapped. Institutional investors, they have to buy equities. They don't, they're not hedge funds. And so they play a game between, safe and whatever. So that game would be, I can see them coming back and buying. Apple had a mean reversion episode. It mean reverted to its 20-month average. I use 20 and 40-month moving averages. Why? I don't know. Why not? The 20 and 40, you can divide one by the other, But I through my time observing things, I found there were mean reverting points. I found safety and security in trying to load up on risk round about those points and paying away when I was like deviations away from those means. So Apple mean reverted to its 20, but all the other riskless stocks, they came to the 40-month. I mean, that's a real severe reversion. So I think perversely, if people begin to kind of adjust the meter and think, treasuries, I'm interested, you'll see a kind of 20-25% bounce in the Facebook, Amazon, Apples, which will be enough to lift indices. But on the next draft down, robust, or what I would call, so risky businesses or commercially risky value things, I think they're the next ones then that really suffer the market's kind of pain and desire to kind of thrash around.
Wow, okay, that's a lot to digest here. But basically, the theme is based on the fact that as people have massively levered up and now they're facing a drawdown in economic growth, at some point they're going to be vulnerable. And China is slowing down as well. So let's say a sharp slowdown is coming, all right? And then you say at some point treasury yields are gonna drop and follow up right there, and that on the basis on that, then the stuff that is most correlated or priced upon treasury yields is gonna rally, like Apple and Microsoft and all of that. The assumption though is that treasury yields are gonna drop, and so I have a question on money. Because we're seeing inflation being reported at 8% in the US, and core inflation is becoming relatively stickier as well. And these guys at the Fed are freaking out. They tell us they're going to tighten all the way. I'm reading Powell yesterday. We have clearly a job to do on cooling demand. Wow, that's quite a statement, man. I mean, he really wants to go there. So are you not, what about inflation? Like, treasury yields coming down, but if inflation is sticky, give me your thought flow on money and inflation. Go with it.
Okay, so this is the point where we start talking, right? That last 15 minutes, cut that, put that in the bin, because that is hypothetical. The market might do this, it might not, etc. Okay, money's Alf, money's too tight to mention. So we are under you've heard mention of gold standards, dollar standards. The dollar standard has today, if you will, if the dollar is a reserve currency, it has morphed into a grotesque Frankenstein version of the gold standard from the 1920s.
Okay.
Where China is in control. And I'm going to beat up on China, but I should be saying mercantilists. But it's the biggest mercantilist. It's got $3 trillion of US securities. Okay. And the world today operates, I believe, I keep saying fragile equilibrium. So China refuses, China's a state-planned economy. It refuses to pursue endogenous economic domestic growth. Refuses it, point blank. Okay. Evidence, that's a statement, give me evidence. Consumption to GDP, consumption share of GDP, it is shameful for such a developed economy. It's telling you something ain't right. So what is it, right? They went through the crisis of the late 1990s, the last period when the great god of macro, Charles Kinderberger, the professor, and his manias, panics, and market, blah, blah, blah. That was the Bible. You made fortunes, fame, and reputation just pursuing that book up until the demise of Thailand et al., the Tigers. What was their vulnerability? They had pursued endogenous growth sponsored by overseas capital, which proved flighty and created an almighty crisis. So, and again, remember, the CCP came in and like its rise was that was the last thing it saw. And so it's like, a message to them, we must never let that happen. So it's another model, okay? And the model is that, so our system, which gets a lot of, people are attacking our system, rightly so just now. Our system, market-based accounting, not perfect, but it seeks to readjust. So China's had a profound comparative advantage in the manufacturing of tradable goods because it has successfully used infrastructure and super smartness to move peasants into conurbations, give them apartments and give them factories and give them technology, and boom, right, they've eaten everyone's lunch. I do not take that away from them. I applaud that. Where it gets gnarly is like our system would revalue their currency higher and higher and higher, and it would take away those advantages. But in doing so, it would enrich the citizenship, the hardworking citizenship of China. You become richer because things made in America would be cheaper. BMW, where are BMWs made? I don't know. Dusseldorf, Munich, I don't know. But one of those big boys made in Germany, a lot cheaper if your currency just went up 20% last year. Sure. None of that happens. And so how do they prevent that? They consciously take the flow of funds from trade and they have a dirty float versus the US dollar, and it's dirty via their engagement. They buy $3 trillion of treasuries, right? And so we're set the wrong way. So the system is set to destroy itself. The system can only work by creating exogenous growth. Whereas the only exogenous growth in the world is America and kind of tiny little liberty satellites, UK, Australia, who are recipients of this mercantilist capital, which is saying, hey, it's like the Median cartels coming into Los Angeles in the early 90s. Hey, take the white powder, take the white powder. It's like the white powder is leverage. We're not hedge funds, we're not commercial banks. We don't want to make a return financially on this capital. We want you to spend it, leverage. Now, in the process, what that's doing is by maintaining the comparative advantage in their favor, we have hollowed out cities, states in America, and those jobs are being replaced and displaced overseas. So when you lose your job, actually you dissave because, again, you got to feed the kids, you got to pay the rent, you got to put gas in the tank to look for a job. You're dissaving. At the same point over in China, they've got no consumption because there's no counter to it. So we're on this conveyor belt to hell, right? So now you've got the Fed, and the Fed, let's just say it, the Fed is stupid, okay? Why are they stupid? Because, their principal perhaps only designation is the regulator of the US banking system. Okay.
Yes.
And in the 1960s, guess what? Like banking went global, banking went offshore, and the Fed don't see it. Like, banks around the world, you work for a bank, you can verify this. Banks create dollars. That's creating money. The Fed does not create or print money. Banks do.
Hugh, sorry, I interrupt your flow, and I'm sorry for that, but I really need to stress this out. I worked for a European bank. The European bank doesn't have access to a Fed account, doesn't have access to direct Fed liquidity. It doesn't, even bank reserves, nothing. That bank can still print loans in dollars. Just think about that for a second, all right? So a European bank with no access to Fed liquidity directly, no access to Fed reserves, no master account, nothing, prints dollars, dollar loans. Here you go. Fund them in the cross-currency market, which means funded in a volatile, potentially runaway dollar funding market. All right, sorry for stopping your flow of thought.
No, thank you. But also, to follow your logic, the Fed has no idea that they're doing it in the first place, right? So the Fed, what is the data the Fed's looking at, right, when it's determining these prices? So again, back to the China conveyor belt to hell, right? That system only continues to create this fallacy of prosperity, but really the reality of great pain, suffering, and a determination to break the system. It survives because it can keep real rates either zero or negative. And that's where we come to the Fed now, and the Fed not understanding this, right? And so again, hey, listen, when we talk about real rates, what do? We look at 5-year break-even expectations, okay? And 5-year break-evens are not the print from this week or last week, right? They're below that. It's people. It's a data observation point, which then will form an expectation. The expectation of inflation presently is about 3%. Would you agree with that?
Yes, it's about 3%. And here it's important. People think that real yields are today 5-year nominal rates. So 5-year nominal rates minus today's inflation. No, guys, no. If we are using the term structure of nominal yields, then we use the term structure of inflation expectations too. We need to discount what consumers are expecting inflation to be. And Hugh is right, it's about 3%. And nominal yields are about 3%. So around about zero right now, real rates, a tiny bit higher. That's more or less it.
So that's actually why why would wise guys, why would they suddenly they'd get a call from someone saying, there's a recession coming that's good, it's a really big one. Like, who's making that call? It's actually, they're just looking at their terminal, right? And they're seeing the real rates are either zero or real rates are going, God forbid, they're going positive, right? Ooh. So, and that's for my sanity and my blood pressure, I cannot watch the blind speaking to the blind. Like Powell was like, I just watch the market reaction, and even that's a waste of time. Okay, the danger is he keeps referencing a hero, Paul Volcker, but we make reputations. It's circumstances make reputations. Okay, so Volcker's reputation was made when in the 1970s, right, when music was kind of like men with shirtless, whatever, guitars. What else about the 1970s? The 1970s was 40 years after the death and destruction of the US banking system, okay, which had a profound change on society's expectations. And society demanded that banks could no longer be masters of the universe and could no longer extend credit in the manner that they had done previously, and society had borne the cost of that recklessness. And so change at the societal level is slow-moving iceberg, and so you're talking about decades. Soros is big. Soros began in '69 with his fund, and Jimmy Rogers. Jimmy, guys, you've got to give him his reference points. So Jimmy's big play right at the beginning was. They wanted to buy US commercial banks because commercial banks in the US were utilities. They were just boring. They paid a dividend. They took no risk. And he could see there'd been a new generation of leadership, all with MBAs, and they were super smart, and they kind of wanted to change things. But the reference, and they did change things, but from a very low level, right? So what I want to say is we deleveraged for 4 decades. total debt to GDP was in the ballpark 1.5x GDP, right?
Mm-hmm.
You agree? Yeah,
Yeah,
roughly.
more or less. Yeah.
More or less. And and with at the end of the 20s, it was like 3.5. So we deleveraged completely. Yeah. And so you could be Volcker and spike rates, right? Say, go home, party's over, you could do that because the environment was kind of benign, right? I'm going to talk about dogs and tails, right? Today, our world is the capital markets, right? And debt is 4.5 times. And we could get even higher figures if you were to bring kind of off balance sheet, but I'm happy with 4.5 times. That is not an environment where you can be Volcker. If you're Volcker in that environment, you burn the house down. You burn it down, okay? I mean, the house is already on fire. Yeah. We discovered with COVID that there is an unwritten rule or a code of conduct, and there's language that you cannot disseminate in public platforms, okay? What we know less well of is that there seems to be an implicit ban on the term depression. The depression somehow went out with John Law, or it's a function of Victorian Britain. It's not, and it's here with us today. We have not regained. Like if you were staring at the world in 2006 and you were looking back at trend growth for the last 30 years, you'd have a reasonable extrapolation point for where global GDP would be today at the end of 2022. And I got to tell you, you'd be out by a factor of about, I want to say, between 20 and 30 trillion dollars. It's insane. Why? Because the Fed's not seeing money creation anymore.
Yeah. And this is so important. Like when you talk about debt to GDP, you're right. And you include the private sector and the public sector, because people forget that, corporates can lever up, households can lever up. We can all lever up in the private sector too. The public sector can also lever up. And plus there are shadow liabilities. We're not even accounting there. We're looking at 400% of GDP across developed nations, 350, 400, depends what you put in there. And GDP, is that the right metric for the private sector? I don't pay off my mortgage with GDP. Fuck's sake, I pay it down with cash flows. I need earnings, I need salary, I need real wage increases. So for me, in the private sector, it's even worse than that, if you ask me. So now the problem is you're looking at a place where if we bring real rates from negative 1.5 to 0 to plus 50, you have an equity drawdown of 20%. That's what we're looking at today. At the same time, we have this inflation, which is running at core inflation. Core services, like the stickiest part of it, was like 6% year on year at the last print. If you're Powell now, it's the last question. I want to leave you the audience with that. You're Jay Powell, right? You're trying to play Volcker. You obviously can't because of what you just described. You look at this conundrum. What the hell is he going to do?
Well, it's beyond his powers, but I have thought about this. What the US has to do, and it's kind of really, you need, we had Plaza Accords going back decades. You need heads. One's heart sinks when you think of heads of state because they're all loonies, but you need some kind of formal discussion at that sovereign level, because we're talking about rewriting either the formal or informal contract which governs the relationships at a sovereign level, okay? And I believe what we have to do is the US has to create a break in the system, a break with the mercantilists where they continue to pursue exogenous rather than endogenous growth. And that can be achieved by imposing a 3%, like at these rates, so I'm like 10 years at 3, let's say, so I'm going to use the metric of 3. I would impose a 3% withholding tax on mercantilist sovereign nations parking treasuries in the US dollar in the expectation that US citizens, that they would rent the balance sheet of US citizens and corporate balance sheets and indeed the public balance sheet to create the exogenous growth that they need back home. I would say, we're going to start charging you that because there are real consequences. Okay, and once they won't balk. They will remember these are not hedge funds. This is the CCP, and its only calculation is the continuation of it's the continuation China Communist Party, the CCCP, right? So that's if you do that, it may be that you can have you can prevent a recession if you move into a world of positive real rate. I'm not sure, but maybe you can have positive real rates. But the hole that Powell and the Fed is in is like they're blaming workers. There's too many people in jobs, or the people are lazy, and it's like they keep raising rates periodically, like 2013. Yellen went in 2016, and then Powell came in and levitated at 2018. And of course, this episode, this is the 1930s, and they're raising rates, and they're destroying the appetite and the incentive for physical capital expansion, to build manufacturing capacity, to build fracking and more oil capacity in the United States of America, more pipelines. You can't do that because the Fed is breaking the capital system. It's making preservation of capital more important than pushing to reward society by a capital that builds a new tomorrow. That's the destruction that the Fed is responsible for, and raising rates will only accentuate that.
Hugh, I had never thought in this way of connecting the China engineered lack of domestic demand, because it is an engineered lack of domestic demand, recycle that capital surpluses and that flow surpluses into treasuries to actually have a withholding tax of that to discourage that behavior, and to actually make domestic demand pick up in China, so that the private sector in the US and in Europe doesn't need to lever up to make up for that lack of demand, which basically means you can delever the unproductive leverage, and you can redo the calculations again and lever up when there is a productive need for capital, as you said. I mean, this is so good. I really enjoyed this, Hugh, and I want to make sure that people can listen more of this solid macro thinking. So where can people find you, Hugh, if they want to hear more about this stuff?
So I'm on Twitter. I think it's Hendry_Hugh, and then weekly, late on a Friday night, as the Acid Capitalist, I tear off my shirt. I'm in my bunker in Saint Barthélemy, and I tell stories, and that can be found Hugh Hendry Official. And that's a YouTube channel. And then if you're flicking through the bikini shots on Instagram using the same label, you'll find me. I'm a person, I have number blindness, but I see the world in colors and shapes and patterns. And so I kind of like Instagram as well. But come, like, take a session at the Asset Capitalist show, and you'll hear more of this chat.
For the rest, guys, you know where to find me. Alf, the Macro Compass newsletter, all free, blah, blah, blah. Just check me out. And also subscribe to the Blockers Macro channels. We're going to do more of these interviews every week. And Hugh, thank you very much for being with us and giving us this wealth of knowledge. Thank you.
My pleasure.